There's a class of stocks called as dividend lots. Normally, I avoid those stocks, but there is a new class of stocks which are very good in value and still give huge dividends. Let's take a look. Welcome back to Be Rich. Normally, when I am asked why I avoid public sector companies when they give such excellent dividends, I say avoid them. I avoid them because there is no wealth creation for the retail investor. All the profits that are made are stripped away by the government, so that they can meet their fiscal deficit targets. There is no investment in the future. There is no buildup of reserves and surplus, and hence these companies have to keep borrowing more. And that is why I avoid ONGC. I avoided Coal India, and both these stocks have fallen by more than 50%. In fact, I advised a person to sell Coal India at 235. He refused to do so because it was high dividend yielding. Today, Coal India is trading at 135 with no hope of it ever reaching 225. He has lost his shirt. But there's another class of stocks which have now recently emerged, which have been beaten down so badly that they qualify for dividend yield stocks. Dividend yields are yields which give very high returns and beat fixed deposit interests at times. Normally, like I pointed out, if you owned ITC for many years, say 15 years, then dividend yields will beat fixed deposits by a huge margin. But there are times in the life of a market when such stocks are available immediately and they start beating fixed deposits within a year or two. This is like a bond with an interest payment coupon. Even if the interest payment is slightly below that of a fixed deposit, once the market normalizes, the bonds will start to grow. So you get to double benefit. The value of your bond keeps growing and you still get fixed deposit returns. Let me take three examples and explain this to you. First, my favorite Karnataka bank. Disclosure, my average price would be about 60-65, and I have been in it for a long time. I would have probably, I'm overstating the value of 65 without accounting for dividends. If I account for dividends, I have already made more money than what I invested. But suppose you had bought it in the last 1 year and your average price is about 50, or for the current price, you are able to bring it down to the current price of 45 rupees. The bank pays a dividend between 3.5 to 5 at times. The first 9 months of the year was good for this bank. Let us assume that March was terrible. Even then, there will be some dividend of 3 rupees 50 paisa. But even if they skip the next year's dividend completely, and you are able to buy this stock for 40 rupees and wait for 2 years, the bank will get back to normal and declare a dividend of 3 rupees 50 paisa. At 3 rupees 50 paisa, your return on your fixed deposit, it beats your fixed deposit return by a huge margin. You get 8% return, whereas your fixed deposit will give you a 5% return. The book value of the bank is 228. Even if it becomes 50% book in 10 years time, the stock will be worth 140, 150. So basically you have made 3 times your bond value, and during these 5-10 years, you would have collected 8% interest. This is too easy to miss, and most people don't calculate stocks like this. Federal Bank is another case in point. It's trading at 39. It was available at 39 rupees. Dividend of 1 rupee 40 paisa, which can translate to a fixed deposit rate of 3.5%, coupon of 3.5%. Federal Bank will bounce back faster than Karnataka Bank because it has a bigger network, and then you can expect to enjoy a coupon rate of 3.5% and double your money in quick time, say 2 or 3 years. Then there is the big boy Infosys. A company like Infosys is in a dividend yield of 4%. If you had bought ITC at 140 and then the company announced that it would give 80 to 85% of its profits as dividend, which translates to a dividend of 8 rupees per share, you would again be at 5 or 6%. These are large companies which have sufficient reserves and surpluses to grow, and they will continue to make profits, which will allow sufficient money to be moved to reserves and surplus, and future business will not suffer. And even if they require more money, they can issue more stocks to get this. Hence, if you can buy these stocks as the markets decline, you will get dividend yields almost better than fixed deposits or just short of fixed deposits. If you can buy Infosys or ITC at 4 to 5% dividend yield, this is as good as a fixed deposit, and you can rest assured that the price will double or triple in the next 10 years. Imagine buying a bond whose capital will appreciate 3 times while the coupon will keep paying 4 to 5% of the original bond yield for next 10 years. Dividend is, in today's rules, dividend is taxable in your hands. So if you can shift the holdings among your family members, you can do more efficient tax planning. So for most people, such deals can be tax-free. So imagine a tax-free dividend yield of 5%, a tax-free dividend yield of 8% in your hands. Even fixed deposits cannot match it. That does not mean that you bet your bottom dollar on this. All I am saying is, such wonderful opportunities are available in the market. It's up to you to use it. Warren Buffett used similar logic to buy Apple. If Buffett can do it, why not you? Thank you for watching Be Rich. If you like this video, kindly press the subscribe button and turn on the bell notification. Kindly share this video among your friends and relatives and ask them to subscribe to my channel. There is a WhatsApp number given below. If you are desirous of buying my books, you may send a number and my team will get in touch with you. Both my books are available on Kindle and you can buy them on Amazon Kindle. If you would like to consult with me directly, send a mail to berichenglish@gmail.com. Once again, I thank you for watching Be Rich.